Let me start with a feeling you probably recognize. Your salary comes in, and for a brief moment, you feel relieved. And then, the very next, you start calculating your rent, your bills, your EMIs. Maybe something broke, like your phone. Maybe something came up, like a medical emergency. And you realize that out of nowhere, now you're suddenly back to zero. With no savings, no buffer whatsoever. Just you waiting for your next salary. And this is not just you. Millions of households across India today are surviving on paychecks to paychecks. But the strange thing is, on paper, income seems to have gone up. Houses are bigger, vacations are more frequent, and life overall just feels easier. Then, what is the problem, you may ask? You see, something is missing, something very primal. Peace of mind seems to have gone down. What we are witnessing in urban India today is a shift. A slow, quiet, and almost invisible shift from surplus to survival. Earlier, families used to earn, spend on what was required, and save. Today, families earn more, spend more, borrow more, and save whatever is left. And more often than not, nothing is left. You see, what was once a buffer has turned into a stretch. What was once safety has turned into stress. And this is not just a personal finance issue either. This is an economic warning. Because when millions of households stop saving, the entire economy becomes fragile no matter how good the headlines look. On the surface, India looks unstoppable. Malls are full, airports are packed, and credit cards are swiped freely. However, beneath this shiny surface, something worrying is happening. Household savings are shrinking. This video is not a financial advice or a market commentary. This is about patterns we are quietly living through. Recent data from the Reserve Bank of India and an independent analysis done by the ICRA shows just how sharp the decline in India's savings has been. India's gross domestic savings rate fell from 34.6% in 2011-12 to just 29.7% in 2022-23. However, in the next financial year, we also saw a modest growth of 1%. Traditionally, Indian households contributed nearly 60% of India's total saving. That pillar, however, is weakening today. India's net household savings are falling sharply and borrowing has increased. People are no longer asking themselves if they can afford this. People are asking, can I manage the EMI for this? And that single question changes everything. Because EMI surely can give you access, but what it does not provide you is affordability. It lets you enter the lifestyle, however, it quietly steals your margin for error. And margin for error is what savings used to be. Earlier, if income stopped for about 3 months, savings stepped in. Today, if income stops, EMIs won't. Loans were once a last option. Today, they seem like the default mode of payment. Zero cost EMIs, pre-approved limits, buy now pay later. Money feels unlimited until it is not. According to RBI data, household liabilities as a percentage of GDP has steadily risen, especially in urban India where aspirations have exploded due to social media. But social media does not show you average lives. It shows you highlighted reels. Better cars, better homes, better vacations. And suddenly, nice to haves have turned into needs to have. So, what fills the gap between aspiration and income? Credit does. And every time credit replaces savings, the safety net weakens a little more. And the worst part is, everyone around you is doing it, so it does not feel risky until something goes wrong. There's also the excitement of markets. Why save your money in an FD when you could invest in stocks? Why park your money when you could grow it by investing? Well, the problem is savings and investing are not the same thing. Savings protect you from shocks. Investing grows your money. However, they also carry their own risk. Many households skip the first step and jump straight into the risk without building a safety net. That works beautifully in good times. However, it also fails brutally in bad ones. and bad times do not announce themselves before arriving. This is why the RBI governor has raised a red flag. He's not worried about spending, he is worried about how it's being funded. The old model where families saved automatically in bank deposits and small savings schemes no longer holds. Today, spending comes first and savings last, if at all. And whenever savings weaken, families become vulnerable. A job loss becomes a crisis and a medical bill becomes a debt. Consumption can drive growth, yes. However, savings create resilience. India wants to become a $10 trillion economy. That dream is big, it's exciting. However, it does not depend only on big companies, stock market, or startups. It depends on ordinary households being financially strong and stable. An economy can't be strong if millions of families are living on paychecks to paychecks. If millions of families are stretched thin, the entire economy collapses. This is how crises are born, not from weakness at the top, but fragility at the base. Savings may sound boring today, uncool or unprofessional. However, they are the silent guardian of economic stability. They don't trend, they don't show off, they don't give dopamine hits. However, when something goes wrong, they decide whether life bends or breaks. So the real question is not how much you earn or how much you consume. The real question is how long can you stand if life decides to push back?